Proactis is a spend management company, spend control company. It provides large buying organisations with tools and services that help them to procure their goods and services more efficiently, more effectively, more cheaply. So we sell to our customers based on buy price reduction, so you can get real value savings on the products and services that you need. You can do that more efficiently through automation, so our software helps you automate it and take headcount out and grit out of the machine to make it more efficient. So again, value proposition. And then also the software enables you, or the tools and services enables you to provide better corporate governance and risk mitigation in your supply chain. So bringing things on contract from known suppliers that have been vetted properly and been through a thorough corporate governance-based process that you design, of course, rather as a buyer, rather than is some sort of regulatory thing. So monetary savings, efficiency savings, and de-risking supply chain. How are we doing, and the size of scale for you now? So we're a 25 million revenue business. We've got 800 customers that are largely UK based, certainly in terms of their decision making, with some in the States. Software is being used across 90 countries, so deployed in a multi-currency type arrangement. And our buyers are using, our buyer customers are using our software to transact with and negotiate with and work with in some way, certainly more than 1 million suppliers and probably closer to 2 million suppliers. So think of us as a mid-market provider. So we are not a tier 1 provider, although we do have some tier 1 customers. So we're a mid-market provider, big-ish customers with on average 5,000 suppliers spending on average 200 million per annum of, importantly, goods not for resale. So we're not a kind of an ERP system that does manufacturing or retail-based procurement. Think about the costs, all of those costs that are underneath the gross margin line. Costs and services to run your business, or CapEx, or IT, or salt for the roads if you're a public sector client. Those kind of overhead-based costs, which if you save £1, it's £1 on the bottom line, or it's £1 off your budget if you're a public sector customer. So a pound for pound saving in those kinds of areas. So here a sort of a timeline on what we've been trying to do, and I'm just going to flick, I'll flick forward a slide in the middle of this. So we floated originally 2006, and we've had, you would say, maybe 4 distinct parts of our lifetime on as a listed company. So we had an initial phase, 2006 through to 2009, of new entrant, probably came on the market a little bit early, had a huge rush on the share price, missed our figure, share price collapses alongside the global economic crisis, and hey presto, we're sat in the doldrums in 2009 or 2010 wondering what to do. So we spiked up and then fell back down. So 2008, 2009, global economic crisis, share price at something like about 20 pence, something of that order. We floated at 43p. And we said to ourselves, okay, we've got a huge disconnect between the customer's experience of the product and the investor's experience of the share price. So customers, we're selling frequently 30 or 40 new names per year. So people like the product, they're buying it, good uptake for an enterprise class piece of software that. Customers buying again from us, so frequent upsell, cross-sell activity, so selling 60 to 80 upsell deals per year. So customers buying again, and retention at really high levels, 90% plus on retention. When customers come up for renewal at the end of their contract, they're renewing at 90%. So customers are getting a great deal of value from the product, but the shareholders are getting zero value in the stock. So a huge disconnect there. So we had to spend some time to address and work out what on earth we could do to rectify that difference.
How long was the average contract?
So at that time, and this is really important as to why we needed to change it actually. So at that time, the average contract was a year. So it was, at that time we were a perpetual license only vendor, which means that your income statement is really lumpy. You could sell a deal for £100,000 on July the 31st and we're heroes. If you sell it on August the 1st, you're a zero because you've missed your number in the previous financial year. So inherently susceptible to missing a figure and therefore risk, and therefore investors staying away, not interested in the stock. So no income statement stability. Also, and we would call that now a low level of recurring income or contracted income. We'd also say that we were subscale, so less than 10 million revenue. Way back in 2010, about 8 million of revenue, 1 million of operating profit, perpetual license only vendor, 2 million of forward contracted revenue only, so very low coverage for the next year. And so we felt that it was those areas that needed to be addressed in order to present to an investor. We took about a year, did some work with some consulting houses to understand, well, what are the drivers that an investor needs to see in order to see value in the stock? And there were a few measures for a software company. So the number one is you need to be at scale. And for us, actually, that is something between 50 and 100 million of revenue. At that kind of level, you can start to see some premium valuations. So if you look under 10 million of revenue, you might be 1 or 2 times revenue as a value metric. Between 10 and 50 million might be 3 to 4 times. Between 50 plus, you might get to 5 or 6 times revenue if you look at the comps. So there's value in scale. There's value in growth rate. So think 25% growth rate is an exciting company, want to be part of that. In the UK market specifically, that doesn't necessarily have to be all organic growth. UK markets are quite happy to take M&A growth as part of that. So growth rate, absolute scale. Thirdly, visibility of income. So a high degree of contracted forward income gives investors a high degree of confidence over next year's income statement, next year's sales target, and therefore next year's profit target. That gives stability to the income statement, which investors felt that they liked. And then fourthly, which is not necessary, it's discretionary, but as a board at Proactis, we wanted to exhibit it, and that was profitability. We wanted to be a profitable business. Now that has a couple of implications. Well, the first implication is that in wanting to be a profitable business, and we said, look, let's target 30% EBITDA margins. To do that, we're going to limit our organic sales growth, but let's at least match our estimate of market growth, which is 10%. So a fundamental principle, financial principle to our setup is that we are going to deliver market growth, which we estimate to be at 10%, and we're going to do it at 25 to 30% EBITDA margins. So superior performance as a solid foundation to our business. We're then going to need to supplement that with M&A to get to a 25% per annum growth rate and show that growth to investors that they're looking for. And we need to get to scale as quickly as we possibly can. And we're going to do it with contracted income so that investors get a high level of security over next year's income statement. And also, of course, it allows you then to access bank and senior-based markets to help support that return for equity investors. And that was in 2010. So 3 years later, so business model transition. The only model that delivers that for you is SaaS-based model. Now, SaaS is a broad church of an understanding. For us, it means long-term contracted revenue. So a contract for us on a SaaS-based deal means 3 or 5 years generally. And we're signing nicely a lot of 5-year deals. We're signing some 3-year deals. And we've still got some perpetual licenses from the old days, which are recurring maintenance contracts. So, and it took us about 3 years, 3.5 years, to get from perpetual license only, so intolerably insecure for investors, to what we are now, which is a blended model. So we still do sell some perpetual licenses because some customers want those, they want the ownership of the software. Most, thankfully, don't, because the cash flow helps them on a SaaS-based deal because they pay as they go. So the return on investment or cash return on their investment works more quickly for them. And the lifetime value of the customer is much higher in SaaS than in perpetual. So that's how we want to progress that model. But it took us 3 years to get from effectively a company that was 8 million of revenue, 1 million of operating profit and 2 million of forward visibility to a company that was 8 million of revenue, 1 million of operating profit, but importantly 7 million of forward visibility. So at that stage you've got a platform then, small as it is at that time, a platform at least to start in a small way with a new strategy, which was along those lines that I described, a 10% organic growth business with a 25 to 30% EBITDA margin as the foundation, the bedrock of what we're trying to achieve, supplement it with M&A to get to those higher growth rates, and then to deliver that M&A over a period of time to get to scale, which, as we say, we're not there yet. We're still halfway there, we would say. Now, and we've run that strategy, that plan, since late 2013 here, relaunch of, with including the M&A strategy. And all we've been doing is this plan since that time. So it's, this performance in the 6 months is just within that context of that period and that strategy. This is all we've been doing for the same, since November 2013. We've just been delivering this story. Latterly, and you can see some acquisitions that we've done along the way. We've done 5 now, including the Millstream acquisition that we did in November just gone. So 5 acquisitions in just over 3 years. And touch wood, not quite wood, touch wood, we haven't cocked it up yet, as we like to say. And then finally, towards the end, what we've been able to introduce is a different part of the procurement, or different side of the procurement transaction. So historically, we have been a buyer-led provider. So all of our revenues come from those big buying organisations that are using our software to procure better. Obviously, they're using it to procure from suppliers, those million-plus suppliers that I described on the first page. To date, we haven't really taken any money from the supply side of the equation, despite us providing or being able to provide some value to that customer group. So we introduced the concept in 2015 that we would try to monetize that asset, that supplier base, that new potential group of customers, and take some money from them. And we've done that in a number of, we have that in a number of ways, which I'll describe as we go through the progress in that area. You'll have read it in the supplier commerce piece in the interim statement. So what have we been doing in terms of our track record then? Well, just going back one, our 5-year CAGR revenue growth on a top line is 25%. Our last 3 years is 35%. Our 6 months here is 36%. All underpinned by organic growth at 10, and I think it was 13 and a bit in the 6 months here. Be really careful, don't judge us on one 6-month period. That sounds really, really good. It is really, really good. But judge us on a longer term basis than that. Our business goes up in waves rather than in a straight line. So for example, the organic growth in the previous 6-month period, or the comparative 6-month period, was something like 4%. So it can vary in the growth rates, but overall we average at 10 over any kind of extended...
That's the 3-year latest, that's the latest 3 years.
Yeah, absolutely. So since November 13, counting back 3 full financial years, these are the numbers that we've delivered. So how are we doing? Well, so growth strategy unlocked in November 2013. We've delivered this organic growth business as the foundation. We're absolutely doing that. We've done 5 earnings enhancing acquisitions since 2014. And if you look back at the share price graph, confused as it is with the spikes along the way, actually if you decipher it, each time we do a piece of M&A, there tends to be a trot up in the share price to some degree. And then it moves around with general market fluctuation. But that tends to happen if you look back at the patterns. So we feel now we've got a track record of being able to deliver, you would say, small scale M&A, slightly growing. The first 3 were 2 to 5 million value, and between 2 and 5 million of revenue. The third one was 5 million quid for a 2 million revenue business with Due North. The fourth one, and this has changed the game a little bit for us. So we acquired Millstream in November 2016. That was a £15.5 million for us. And at the time, the share price, when we did the deal, the share price was 124. We raised the money at 135. And we were looking to raise 10. And we came out with a book of 40 at a premium. So we thought, hang on a minute, we've got a bit of a window here. People are really enjoying the stock. There's some value in it still at that level. And there's some excitement around the stock. So we've got a window to deliver something really exciting. And that's kind of where we're at now. We've got a really good window of opportunity to deliver something really substantial. We're starting to work more on the supplier commerce piece, and I'll talk about that a little bit more in connection with the Millstream acquisition later. Getting up to 25 million, so 10 million 3 years ago, 25 million here. Market expectations in FinCap's notice, I think, is just short of 30 million revenue for next financial year, which starts 1st of August. So we've got to get our skates on to get there. But the same underpinning principle of 10% organic growth on top of full year effect of Millstream being acquired, with a little bit coming in for the supplier commerce piece next year. So all eminently doable in their 3 pieces against this strategy that we've been running for 3 years or so. And all the time delivering shareholder value. So I mean, this is a reset index, but this is where we were at in 2010, in the sort of wilderness years, coming through the business transition, business model transition. First acquisition, February 2014 in there. Shareholder investor change in late November 13 when we relaunched, and it's just been moving along, you know, very, very nicely. So think of us around here at about 30 pence. So in 3.5 years, we've delivered sort of 6 times, you know, as we've been delivering this story. So against that sort of longer term track record, then how have we done in the 16 months? So here we go, the key messages to take home. So in our income statement, 13.4% solid underlying growth. For us, that's a little bit after the Lord's made sure, because the reason why it's so big is because of the deals that we signed last year, those new name SaaS deals where you get all of the revenue in the following year. So it was going to happen, but it's come and it's great news. So 13.4% organic. On top of that, we're up at 36% overall top line growth. So delivering against that plan and those ideas, 25% underlying EBITDA growth. So we're at 3 million EBITDA on the half year, 2.4 million previous year. We're executing on M&A. We've done the Millstream deal. We paid £15.5 million for it. We said that business would do 5 million per annum revenue, 2 million EBITDA. And in the first 10 weeks, and we disclose it in the interim statement, it's done precisely that, a little bit north of that actually, 1,050,000 revenue and 420,000 of EBITDA. So 40% EBITDA margins in that particular business. So really exciting, and we'll get a full 26 weeks in the second half. So absolutely delivering on M&A. And actually that deal has opened up the market for us from an M&A perspective. So our pipeline of deal inflow is really quite high, really quite exciting, and of a different calibre and nature to ones that we were seeing 2 or 3 years ago.
So what do you mean by that, Tim?
Size and scale of the opportunity, yeah, but I think it's because you know, vendors or corporate finance vendors are seeing that Proactis now has a market cap and a capability to raise relatively serious amounts of money. Now, the trick is to get value for that money, of course. So we have to work carefully with that one, but much more opportunity coming through the door. And as we see on the share price graph, we tend to be able to get some kind of value accretion out of it. But when we evaluate an opportunity, we go back to that tile and we look at these kind of measures. How quickly does it get me to scale? What kind of growth is it exhibiting? What's the contracted visibility of it? How profitable is it? Because I don't want to be diluting the group by bringing an acquisition that is no visible revenue, for example, or is not growing, or is highly unprofitable, and I can't get it to profitability quickly.
Sorry, Tim, can you just, maybe you're going to cover this later, but as you were saying earlier, so as revenues go up and get a high multiple, presumably that's the same, as you said, with buying slightly bigger companies, you've got to pay high multiples for them.
Yeah, absolutely. So I mean, that comes with the game. Yeah, absolutely. We would definitely say that. And I think we said at the time when we were looking at EGS and Intersource that we got some really good bargains there. I mean, I think we paid on average 1 times for those 3. Yeah, 1 times revenue for each of those 3 first early acquisitions. On a profit multiple, they were quite expensive because they were pulling it as an independent entities. They were sort of fully loaded from a overhead based perspective. So maybe delivering, 300,000 operating profit against 2.4 million revenue, and I've got to pay 2.4 million revenue for it. So I'm buying at 8 times, but I'm valued at, in those days, 5 or 6 times. So it's kind of a, what are you doing? You know, this is crazy. But you've got to we had to get on the march with it. Now we were able to do it with cash off our balance sheet, so it wasn't dilutive in that sense at that time. So we were able to live with it, but we knew that we could take the cost out of it. And as an example, that particular business has done 350,000 for us in the first 6 months. So we've been able to double and a little bit more that company's EBITDA, or that product's EBITDA as it is now, because those companies they're in existence, but they're not run as separate companies. They're run as divisions or products on a fully centralised arrangement.
This 6 months has got about £1 million of revenue from Millstream in it.
Yes, 1,050,000, yeah, and that would be 10 weeks worth.
Yeah, but if we take that out, then there hasn't been any growth from the second half of last year.
Yeah, and that would make sense in some senses, because if you think what we've got there is then due north for 6 months in this first half, and due north for 6 months in the previous one, and then we talk about, well, let's have a look, well, why isn't there growth in 6 months to 6 months? And then we look at the mix of the type of deals that we've sold in this particular period. Now, so in the first half of this period, we haven't got any individual one-off perpetual license sales. So you've seen the mix of deals has shifted to 22 out of 27 were SaaS-based. In the 6 months of the second half of last year, that mix was different. And it had some fairly significant perpetual license deals in, because some people still want to buy licenses. So that can skew it in any one particular 6 month period.
Could you explain how the Millstream fits into your product portfolio, so to speak? Because you don't want to be buying a rag bag of different things that
How dare you?
can't be integrated.
No, absolutely. And this is really important for Millstream, because it's coming back to, it's perfect timing actually. So we acquired it. Now, our higher growth opportunities are on the supply side. So here we could get into some really tangentially high growth rates. There's nothing in the figures for it, or very little in the figures for it in the market, because we don't want to get up ahead of ourselves in terms of our predicting a new line of business. That new line of business is in the supplier side of the procurement equation. So Millstream is a supplier business for the large part. 75% of its revenues comes from the supply side of a transaction. So think of small businesses paying them a small annual subscription for a service, which I'll describe in a minute. The other 25% is buy side, so just exactly in our core competence. So we bought that company because, well, number one, it is delivering this, and that gives us scale in sales and profit, which we didn't have before it. The second thing it does strategically is it gives us knowledge and know-how and capability of understanding that customer group that we don't yet understand, but which we need to understand if we're going to be successful in exploiting that supply side opportunity. So now what it actually does is it trawls all of the EU tender publication notice boards for all of the tenders that are being brought to market by certainly public sector bodies, but also some others that are commercial sector actually that have notice publication boards. What it does then is it filters all of that information against a set of parameters that each of its supplier customers gives it, and presents to those suppliers the tenders that may be of interest to those suppliers. So it's almost like a marketing lead generation tool. It's an outsourced marketing team really that say, look, I don't want to trawl through 100,000 different tender opportunities to find the 300 or 400 that might be of interest to me. I'm going to present some credentials or some parameters to Millstream and through their tenders direct product, and through those parameters Millstream are going to filter all of the tender information for me and present me with good opportunities. So it's outsourced marketing ultimately, but it's important that it's really adjacent because it's on the procurement side. It's with a supplier base that we're going to be selling to in nature, and therefore it's really interesting for us.
So is that going to be affected by Brexit if it's based on EU?
The reality is that most of the suppliers are in the UK, so are not going to be that active in fulfilling contracts in Germany or further afield. Ask yourself this question: is it likely that the EU is going to start to break the law by not allowing people to bid against contracts? Will they force the commercial markets in their territories not to come to the UK for a particular product?
Can they go outside the EU at the moment for a particular?
Absolutely. So yeah. It's just that the market that we are presently serving through Millstream is the UK SME market of suppliers. That's who we are naturally affiliated with. So now we understand what that company does. So our acquisition in 2014 of a company called Intersource Inc. So Intersource Inc. is a provider of outsourced services to large buying organisations to run reverse auctions. So what that means it does is it has 40 customers, big buying organisations. It has a population of suppliers, 30,000 suppliers. And what it does is take a contract from the buyer that the buyer wants to place a tender for, and it runs the tender process through an auction across the number of suppliers that it sifts through that might be appropriate and relevant to provide that service or that product. And it then invites those suppliers onto the auction platform to participate in the auction. It trains the suppliers to how to run the auction itself online and to coordinate. And it helps the supplier then negotiate and work with the buying organisation post award. So it's doing something that's very similar in concept to Millstream. There's a bunch of contracts out there from large buying organisations that Millstream are presenting to suppliers, and the suppliers are paying for it. It's doing it from outside of the tender, you would say. So it's not involved in the tender, it's just presenting the information. On the other side, in our managed service offering out of Phoenix, we've got a bunch of buyer contracts that we're presenting to a population of suppliers that they might win that contract. So we're doing the same thing in reality, but from a slightly different angle. So our view here is that we can monetize the supplier base. So supplier commerce in this respect means presenting a service to the suppliers in our Phoenix managed service offering that allows them to participate in tenders, allows them to present information about themselves that is easily collectible via an online tool by the buying organisations that the buyers can search against to find appropriate suppliers in the first instance. So, and we think that a supplier should pay for that. And so what we're trying to achieve on supplier commerce in that scenario is then to charge those suppliers for those services. And as I said, there's about 30,000 suppliers. There's 2,000 that they use very regularly. There's 8,000 that they have used in the last couple of years, and there's 20,000 that they have used ever. So it graduates out a little bit. But the price point there is $1,000 a year for a basic package, or $2,000 a year for a premier package, want of a better phrase. My term is not the name of the product. So there you can see the scale of that opportunity is really quite high. So 10 to 20% take-up rate will double the size of our buy-side business, our managed service business there. And that's accelerated through cross-selling the concept. It's not cross-selling the product, but it's identifying a concept and applying it to a different part of the group in, we think, an intelligent way. So we've counselled with the buyers to see what value they would see out of having that source directory or supplier directory that we're calling it for now.
Have you got a shared sales force selling all these different solutions to?
Well, the beauty of this particular one, and we do it based by a particular example, is that we're already liaising with the suppliers on a daily basis to help them through the process of going through the auction tool and using the auction tool and inviting them to the auction. So whether it's email or telephone based, we have a supplier, a sort of a customer services team whose job it is to liaise with the suppliers to get them to the auctions so that the buyer can get a good tender out of it. So we're already talking to them. So there isn't a need for additional cost to push that. And in the early days, obviously it's crawl, walk, run. So we're not just going to throw Proactis like this. We don't throw a team of 10 at something, see if it works, and then if it doesn't, get rid of them. We're crawl, walk, runners. So we'll go small scale to start with, then we'll build it. We've got a target of, 500 or so for the end of this financial year. So we're expecting to see some traction in that area quite quickly. And that's probably going faster than we thought that we would go in that particular area. So some detail then. So as we said, a bit of a repeat here probably. Reported revenue, 36% growth to 11.8 million. Underlying growth, 13.4% in the 6 months. Real crucial measures. Actually, this would be the most significant KPI that you should look for in our statements, because that's the security number. So just short of 23 million of annualised contracted income. So that's not visible income. That's not the stuff that may come in or may not come in. That's actual contracted revenue. Now, it's subject to retention issues and it's subject to inflation issues, but that's the number that at any point in time, or this particular point in time, is our estimate of annualised contracted income. Now, compare that with, I think 25.5 million is our consensus for this financial year. So it's not a perfect match, but it's heavily covered. So forward order book and contracted all moving forward very nicely. Lots of contracted income in the Millstream acquisition that's helped that number. EBITDA, as we said, increased 25% to 3 million in that 25 to 30% EBITDA margin range, so just where we want it to be, so delivering there. And a good strong balance sheet still with 2.7 million of net debt. So we've gone into a debt situation. We took on some debt to acquire Millstream, but it's less than a third of current year EBITDA, so very, very low on the leverage side. So lots of room there if we need to move quickly. Deal activity buoyant, so 27 new names. Our internal benchmark there is 60 for the year. And the reality is that a range of 50s to 60 is fine. 60 plus is really good. Below 50, we're a bit disappointed. So nothing's black and white in business, is it? So those kind of ranges is what we're looking for this year. Favourable shift to we love SaaS, absolutely love SaaS, because the lifetime value of the customer is much higher in that sense. It's contracted forward income. SaaS deals are 3 or 4 or 5 year terms. We've been asked for 10-year terms, those sorts of things. Perpetual is not very good for us. Puts a little bit of a spike on the income statement from a sales perspective, as I think Andrew asked. So perpetuals give us a bit of a spike in a particular period, and it doesn't give us good value in the long term.
What proportion of your sales are SaaS?
So SaaS plus recurring annual maintenance plus the managed service piece that behaves just like SaaS plus the annual subscriptions is the majority of that of this number. I mean, that is what that number is, really. So it's a very, very high proportion now. Really important for us this particular period is this element. So when a customer buys our product, it doesn't buy everything. And on average, we're about 30 or 40% penetrated into our customers. So that means there's a hell of a lot to go for, whether it's additional modules or it's additional seats or it's additional divisions that we should deploy the product in, or it's different elements of the software. It could be like a spend analysis, or it could be AP automation on top of a P2P implementation, or on top of a source to contract information. Lots of different elements of the overall offer. And so what we have done there is to accept that there's a huge opportunity. So we, about 18 months ago, built a sales-based inside selling team, sales-based account management team, looking to create an increment. And I think I described that we historically did 60 to 80 upsell, cross-sell deals, inside sales deals per year. So we invested with a view to doing an internal benchmark of 100 per year for this year. So we're ahead of that right now at sort of 59 for the half year. So more than happy with that kind of performance. And I described the progress on the supply commerce side. And we've talked to death, I think, Millstream, unless anybody's got any more questions. This should be almost like a recap of the growth strategy. It's all over the interim statement. We put it, what we're trying to achieve, forward. So 4 legs. New customers, so it's really important for us to be able to display new customer traction, shows the attractiveness of the product on the high street. So really important to maintain that. That's why we invest so much in our capitalised development costs that you'll see in the cash flow statement, and the amortisation come out as well. So we capitalise and amortise rather than just charge in the year. We're about at parity because we only use a 3-year period on it. So we're about parity, and we don't vary it much year on year. It tends to be a fixed capacity that we have, and it's people in boxes. So new customers is really, really important to us. Maximising penetration, as I've just described, getting us, once we're in there, think of it as a journey for the customer. They might just buy sourcing, which might be £5,000 a year on a pro contract product. The idea then is to sell them in some contract management and some supplier relationship management, and then into P2P, and then into AP automation, and then into spend analysis. So lots of a big journey for these suppliers to go on. What we've got to try and do is get them hooked in as quickly and as easily as possible. Now, some people are happy to hook in at 150,000 contract for source to contract or P2P. Some want to do a £15,000 contract on sourcing only. And that's their journey to start with. And what we've got to do is you see the benefit that you've got there, move on to this piece now and get these benefits, and move on to the next one. So it's that kind of relationship that we're trying to sponsor by getting the hook in. Supplier commerce, we've talked about the 3 different areas there. So we've got that Millstream area, which is just growing that customer base, selling more annual subscriptions to supplier-based customers. We've got the sourcing directory, that's our application of that Millstream concept into our managed service business in the States. And then we've got networking capabilities through transactional flow between purchase orders and purchase invoices back and forth between buyers and suppliers. We need to move quickly on that now. And then also through that you get an opportunity to create an accelerated payment facility for suppliers. And a good example is P&O Ferrymasters, where they've got a team of 7,000 different haulier carriers, men, owner-managed businesses running their tractor units, doing a run from Harrow up to Manchester, picking up in Liverpool and going back to Harrow. And they're sat in their cab at the end of their run, and they've got a purchase order for £2,500 to do that journey. They've completed it, they've dropped the trailer, they go online on their iPhone, they can click, I've done the job. So they flip back the purchase order as an invoice back into P&O's accounting systems. P&O's has an immediate match because the goods received guy said, yeah, I've had the trailer, so I've matched it. That then becomes status report approved, because within the tolerances of that accounting system, it said my purchase order matches my invoice and I've had the service. So it's now a payable in 30 or 60 days time. So we go, okay, 60 days time, that's a 7% discount, let's say, against that particular invoice. Do you want your money now? And it flips up an email to him saying, do you want your money? Click on this link, you can get there. You can take your money now. Now he's sat in his cab, does he say, right, I've got £2,500 in 60 days time, or I've got £2,350 now? Now if it was a sophisticated customer with a £100,000 invoice, he's going to say, naff off, I'll go to the bank and get an advance against it. But that's not what we're hunting for, that's not where this product's set. Again, we've left as much of that out of the numbers as we possibly can until it's real. So we've been talking concept, we've got early adopters in the programme, we're going through that process, it's quite painful, but we're building a product rather than a concept. And when we've got a product, then we can roll it out more widely. And then acquisitions, as we've talked about probably at length now, we're highly active, very busy on it. great opportunity. The market is consolidating quite quickly. We think back before my time, maybe 30 to 40 years with HR and payroll software systems. So a huge number of fragmented offerings ultimately consolidated up over a period of time to a half a dozen fairly big packages. Financial ledgers, the same thing maybe 20 years ago. ERP systems maybe 15 years ago grew from lots of smaller ones, consolidated up to the 4 or 5 that are sort of key players today. CRM systems, the same principle. We don't see really that there's a huge difference here. It's enterprise class software in spend management should follow the same kind of pattern over time, and we're kind of in the middle of that now. If you look at the sort of 6 months history, there's lots and lots of activity going on in this area. The messages that we want to get over are that we have had a excellent 6 months in the income statement. If you look at it, 13.4% organic, 36% total top line growth. We've executed on profit and profitability. We've executed on M&A. We've accelerated some stuff in the supplier commerce piece. We're going through the process on the networking element of the supplier commerce piece. And there is still that, we have a huge opportunity in this business we think to create a whole load of value going forward. There's nothing in the market that suggests that that's changed in the last 6 months, but this is a long-term kind of market. It's not a fluctuating kind of market. So we think we're in a great position to continue this kind of story.